to JPX Energy Market Weekly Updates. Crude oil futures settled recent low levels last Friday, with the IEA set to release a second batch of emergency oil reserves following announcements of record US SPR release last week. Intermonth spread of major crude oil benchmark fell more sharply last week. Spread of JPX Dubai crude oil future contract for June and August delivery fell to 1,870 yen, or roughly $2.4 per barrel, while the same spread for IC Brent crude was trading around $3 per barrel. Both fell to a level before the military conflict began, indicating a less tightened crude market. Investors' positions in crude steadied last week after heavy sales in 2 previous weeks, as fund managers tried to balance the opposite risks from sanctions on Russia and a potential global recession. The extreme volatility of markets since the end of February has driven a shift to risk-off positioning as costs increase for holding paper positions in the market. Heightened volatility has fed through into more demands for margin from brokers and clearinghouses and makes future positions increasingly expensive to maintain, encouraging fund managers to trim positions. Cuts to open positions have reduced the overall open interest across all oil future contracts on IMEX and ICE to levels not seen in early 2015. Diminished market liquidity and heightened volatility have fed off one another in a classic positive feedback loop, linked to large price swings as traders struggle to assess competing upside and downside price risks. This chart shows the trend of crude oil volatility index, which measures the implied volatility of oil prices and is calculated using movements in the price's financial options for WTI. Historically, though, high volatility does not necessarily mean prices have peaked, but diminishing liquidity followed is worth noting. Crude oil futures settled sharply lower last week, largely because the White House announced it would release up to 1/3 of the nation's SPR, or equally 1 million barrels per day over the next 6 months, in a bid to combat high energy prices. In November, the United States had announced 50 million barrels in releases, with another 30 million early March, alongside 30 million from other nations. With these sales and several other legislative drawdowns, U.S. SPR could decline from 618 million barrels to about 350 million barrels by the start of next year, the lowest level since 1983. Followed by the United States move, the International Energy Agency agreed on April 1st to a second emergent release of oil reserves in response to market turmoil, but said details of these release would come early this week. Last week, it is heard the Russian oil pipeline operator has informed local oil companies will be capping the intake of yet-to-be-sold crude because of full storage. Many analysts say it's a matter of time before at least some Russian supply come off the market. The IEA had previously estimated Russian oil losses could reach 3 million barrels per day in the second quarter, but most forecasts more cautiously estimating 1 to 2 million barrels per day. So the reported release would probably help the oil market rebalance in 2022. But many analysts also question the longer-term impacts of the SPR release, considering the likely requirements to refill the SPR in the future. Some analysts describe the release of SPR as a band-aid solution for a major wound. Goldman Sachs notes that the SPR release will not resolve the oil market's structural deficit, because the oil market is still critically underinvested as energy transition and ESG considerations after oil's golden era between 2010 and 2014 has capped capital expenditures with inadequate production capacity to meet future demand recovery. Besides the SPR release, the OPEC and its alliance agreed to boost output by 432,000 barrels per day in May. That is a slight increase from the previous month's increases of 400,000 barrels per day, with a slight readjustment of quotas. That include 113,000 barrels increase for Russia. Taking into account the decline in Russian production, there may not be any increase in OPEC Plus overall production in May. It's also heard the technical committee of the OPEC group has dropped the IEA's data as a second source of member oil production data. Based on recent media reports, some countries in OPEC are unhappy with the IEA's attitude towards supply control. Even if OPEC is willing to increase production at a faster pace, the underlying supply picture remains tight, with low inventories and spare global capacity estimated just 1.4 million barrels per day by June. Although the forward price may become more flat in the recent future, the curve as a whole may still stay high and well above the marginal cost to encourage more investment in the oil market. Okay, that's all for this week. For more information, please stay tuned to the JPX Energy Market Weekly Updates.